Welcome to your Wealth Conscience podcast. My special guest today is Martin Cobb, Senior Vice President of Equities for Lorne Steinberg Wealth Management. And we're going to talk today a little bit about, one, getting to know a little bit about Martin. We talk about his approach to picking the right companies for a portfolio. We talk about, taking a practical approach to how you can apply that to your own day-to-day living, decisions you're making on your own total wealth journey, and how are you really making sense of this headline news? What matters and what doesn't? Stay tuned. Well, welcome back. Today we have Martin Cobb, Senior Vice President and Equity Portfolio Manager here at Lorne Steinberg Wealth Management. Welcome, Martin.
Hi, Penny. Glad to be here.
Great to have you. And gotta be honest, I miss walking down to your office and just having a conversation.
I do too.
We're basically just on this format for a little while. Calls, text, obviously. But it's good to put a conversation and a face all in one, and I appreciate that. So let's get right into it. Martin, you are an equity guy. You're an equity guy through and through. And why don't you tell us a little more about just how you got, what drew you to the analyst side and loving to, review companies and build portfolios from that perspective? Because you have a great and unique perspective about how you go about choosing stocks, which I really like, and we really, connected that way. And we'll talk about that in a minute. But why don't you tell the viewers a little more about you and who Martin is?
Sure. We have to go back, I guess 35 years, when I was a teenager. I was a teenager in Scotland who grew up in the 1980s. It was a really exciting time. I was given my very first investment book, my best friend's dad. It was called Investing for Beginners, written in 1985. Read it cover to cover. This was pre-Big Bang, but it happened at the same time when Margaret Thatcher, who was the Prime Minister, was privatising a lot of the UK companies, British Gas, British Petroleum. And you saw pictures of, I don't know if you have them over here in Canada, yuppies, these young upwardly mobile professionals back then. It was exciting. The stock market was pushing on for new highs. And I just got caught up. I bought my very first shares, I think, as a 13-year-old. I think it might have been British Gas. I can't remember. And I loved this idea of it being an analytical thing, but also very much a behavioral thing. So when I was probably 17, 18, thinking about a university, I'm a mathematician, rocket scientist by background. I did one of these questionnaires you fill in and it pops out, your job choices. Yeah. And the investment analyst came out number one. And I didn't quite know what that was. But it drew me into that whole investment world. And after I graduated with my rocket science degree, I went straight into that in my early 20s. And I've loved it ever since.
Excellent. And I know we both came from very big companies in the beginning in terms of how we progressed in our careers, and now we find ourselves in a more intimate investment firm. So, tell me a little more, because I know I think I share that story often with clients and prospects in terms of why I chose Steinberg Wealth Management and making the move from big to small. But why don't you share with us what resonated with you and why you chose Steinberg Wealth?
I took some time off after I left Franklin Templeton. I'd been with them for 15 years and enjoyed my career there. I took some time off to have a real think about what I wanted to do next. Mm-hmm. And I actually wrote down on a sheet of yellow legal pad the impediments to doing this job well, the impediments to investing for clients well. And I interviewed and spoke to a whole host of different companies, both here in Canada and also across the world. And effectively interviewed them against those 11 impediments. It's fair to say that Lorne Steinberg Wealth Management ticked less boxes than anybody else by far. Small company, privately owned, doesn't have quarterly numbers, doesn't have shareholders, invests our own capital in a long-term basis alongside our clients, et cetera, et cetera. And I like the people. So that's why I came along. I was usually working with 8,000 people. I went from that to working with a dozen. Where's the stationery cupboard? That question was never answered. So it was quite a change, but it's been a great change. And I always wanted to invest as if it was my mum's money, would do it properly, and I could come in every day on that basis. And that's what I do at Steinberg Wealth.
Yeah, that's excellent. And I mean, the basis of doing the show and really, for me, it's helping people take a practical approach to how they can apply, common and complex financial decision making to their own total wealth journey. And I think part of that, and this is why I really appreciate you being on the show today, is talking about and giving people kind of an inside look of how we converse on a day-to-day in terms of, I focus on the total wealth. I focus on understanding the clients, where they're at, understanding, what the best position they should be in from a portfolio perspective in terms of asset allocation and portfolio construction. And you play a critical role in just being that guy who is tasked with focusing on and monitoring all these companies and knowing, when we should boot one out, when the next one to bring it in. And I think it's important because the level of work and time I take to really understand and know the client is essentially the same level of work and time you need to do to really understand each and every company. So why don't you share a little bit about, from start to finish, how a company or how an opportunity comes onto your radar till the time that, you're ready to say, this is a good time. Let's make our move on it.
Yeah. It's good that you keep me away from the clients. It's more than enough work on your shoulders, and I can sit in my little library and work away. To be honest, my investment philosophy and approach, I've stolen from the best. Looking back over 30 years, I started my career at Baillie Gifford, who've been one of the most successful asset managers in the UK ever. I've worked in other organizations, I say, but I've also read probably more books than anybody I know on investing, on stock market history, and also the whole behavioral side. Right. And I've just stolen those ideas and packaged that together. I took some time off to really think how I would want to invest, where my mum's money, and move forward with that. I've learned through painful history that you don't want to take a risk with the balance sheet, the viability of a company. Things happen, pandemics happen, believe it or not. And you need to be investing in companies that not only survive, but may well thrive when things go pear-shaped, as they inevitably do. So that's the first kind of filter. The second one is really trying to understand the business for what it is. A lot of investors, they look at the share price and they decide if it's a buy or a sell. I try and ignore that noise for now. I look at this. I look at what they've generated, the profit and loss account, their balance sheet, their cash flow, the returns on equity, the whole idea of an economic moat. And what would I be willing to pay for this business without looking at the share price? It's really hard to do because we're always influenced by what's going on in CNBC and BNN. And then I consider it versus the share price, and I look at the disconnect, and are we getting a margin of safety? I love buying great quality businesses. They're not always on sale, but with a universe of several thousand companies around the world, there's always opportunities. I do use screens occasionally. There's some very sophisticated software out there, but when you've done this job for 30 years and you've been a stock picker and you've loved your job for 30 years, there's lots of stuff I've owned in the past, I may well own again, that comes in and out of the portfolio. And the last thing I would say is this idea of a competition for capital. We own around about 50 stocks in the Global Value Equity Fund. We own about 20 within our Canadian Dividend Growth Fund. Every one of those has to justify its continued inclusion in the portfolio. And when a new idea comes along, it has to justify one of those being kicked out of the portfolio. This idea of a competition for capital, a limited number of ideas to make sure we have the best ideas in the portfolio at any one time.
And I think that's important to really note. And I think the viewers can really take away from that in terms of, how they can apply that even to the day-to-day financial decision making and understanding, where their money's going and the value piece. And I think we're going to talk a little more about our definition of value investing. Outside of, some people might think traditional value investing in terms of deep discounted companies, buying them and really just holding them and waiting for that one event where that, the price just pops and they go, okay, thank you very much, I'm going to sell it. But, really focusing on, we go back to values and beliefs. And for people in terms of their day-to-day living, just decision making from anywhere from, grocery shopping to, whether they're buying, that major appliance, dishwasher, washing machine, waiting till something goes on sale because they know it's a good quality thing, but they know they can get it at a discount versus buying top dollar for it. These are the kind of things that I think people can really take and use. So you don't need the actual technical and intellect of really, the pieces of what you need, right, in terms of choosing the right company. But they can apply very basic pieces of those disciplines into their day-to-day. And so, for instance, you want to align yourself from a value perspective of, many people go grocery shopping. Are you always going to buy something that's never on sale? Or are you going to look at, your 2 bottles of pasta and go, well, your tomato sauce, and look at one and that's regular price, $7.99, and the other one's on sale right now for $4.99. How are you spending your money? And when it comes to, looking at investing, there are pieces of investing that are outside of the portfolio in terms of, investing in yourself, investing in certain things that are going to add value to your life down the road. So it's being cognizant of just, and I know we see the headline news and we see a lot of these younger investors that I think are more drawn to the narrative and just like a storyline versus really doing the homework of, the substance of that storyline. Doesn't make sense. Is it going to be around for a little while? Are you just, throwing your money in thinking it's going to, because the story's telling you it's going to be so great in the next few years and it ends up being rubble. But it's important to be able to take certain those pieces in your disciplines and applying it. And that kind of brings us back to, what value investing means to you and me and how people can apply it out there. So why don't we talk a little more about value investing and the philosophy behind value investing? Because I like to think there's 2 different ways of thinking about it. One from a pure, when to buy and what to buy versus the value within what you're actually buying. If that makes any sense.
To touch on that, I think it's interesting you're talking about grocery shopping. Investing is the only universe I can think of where if the price of something goes up, people find it more attractive because the story, which is driving that price increase, it's people get on board. And, you have to kind of look at investing very much as you look at grocery shopping or buying a second-hand car. You try and establish what it's worth and you look to buy it at a discount to that. And that's the essence of really all purchases that we're trying to do. We're not helped by, in the investing world, we're not helped by the fact that consultants somewhere along the way have decided there are 2 buckets. Well, there are several buckets, but 2 buckets, value over here and growth over there. As if there's some idea that the growth rate of a company, a higher growth of companies should not be a value stock and value stocks shouldn't have growth. And to me, it's never made any sense. I really don't get it. And you see a number of value managers, you go to their websites and they talk about they prefer value over growth. Like, that's ridiculous. Yeah. Sorry, I'm getting a bit passionate here. Surely the growth rate of a company.
I'm in your camp. This is what we really, we connected this way because I'm like, what is happening?
Exactly. But you mentioned, this idea, there's the cigar butt type investing. And Warren Buffett talked a lot about that. As an early investor, this idea that you find a cigar butt that's still got 1 puff in it and it's worth something. And sometimes, and we do own a few cigar butts, I would guess. Sometimes, there's merit having those stocks in the portfolio. Yeah,
but it doesn't represent a huge piece of it. And I think that's the main thing. It doesn't, you're not going all in on this one, last puff concept, right?
Yeah.
It's maybe like a piece of it, which is it's negligible almost. But you really want to structure your portfolio and the choices you're making based on, obviously level of importance, but what's going to make the most impact for the longer term.
Yeah, you touched on it earlier on when you mentioned an event happening. When you buy a cigar butt, you're getting no help from the business. Right. Usually the business is crummy. It may have a lot of cash. You kind of hope that the management will do something sensible with that cash, and typically they don't. To the other end of the spectrum, you buy great quality businesses with economic moats, and I can name a number of names. The business is on your side. The business is reinvesting, able to reinvest at high returns on equity, high returns on capital, and drive the profitability going forward. And in that case, the business is helping you out. I much prefer those types of entities. That being said, at times, those types of entities get very expensive. But as I said, with the universe of 7,000 companies, with all the countries in the world to choose from, there's always something that's on sale.
And I wanted to touch on that a little more, because I find the way you break out how you bucket certain companies is interesting, and I think it makes more sense than your standard when viewers out there, when you're reading like a mutual fund fact sheet, or you're talking to, or you're hearing on podcasts, or again people on BNN talking about mid cap, small cap, large cap stocks. You break it out differently, and I think it makes more sense, because it just intuitively people can just gravitate toward that without, again, having that technical or intellect of just knowing what that means. I think there's a level of intimidation going, I don't know, I haven't read those books and I feel like it's beyond my scope. But you just break it down to a little more simplistic terms. You go, yeah, that makes sense. So talk to us a little more about how you bucket.
Yeah, I have a number of buckets. The first one is secular growers. So these are companies, think Microsoft, think of Tektronix. Tektronix actually is the world's leading power tools company, owns Milwaukee and Ryobi. These are companies that have secular growth. Through thick and thin, they've continued to grow well above GDP rates, both profitability, sales and profitability.
And that's secular, and I was going to say secular is a term we use because that means their trajectory and their growth goes beyond a 7 to 10 year mark. So,
and yes, it's less cyclical, it's less GDP dependent.
Right, so secular means it's going to be there for the longer term. There's a certain trend and trajectory it's going for a very long time. Whereas when we talk cyclical, and to its very nature, it's a cycle, right? And so cycles tend to last far shorter than the secular. So you got your cyclicals, which again, you can even think, we have 4 seasons in the year. That's cyclical. Right? Yeah. So the cyclical in your nature is kind of, it maps it to obviously the markets and the business cycles, but there's pros and cons and understanding when you want to keep certain ones and when kind of testing what season are we in.
Yeah, yes, that's a very good way of putting it. Yeah. Yes, we have a couple of cyclical buckets. One would be what I would call growthy cyclical. So these are entities, businesses that if you look over time, there's been a definite cyclicality in their profitability, but the trend is up. So the trend is up. And secular growers plus growthy cyclicals plus a third category called steady eddies, which are your food groups, your food retailers, the really strong, steady spirits businesses like Diageo. That's the bulk of the portfolio. About 3/4 of the portfolio are in secular growers, steady eddies, and growthy cyclicals. Cyclicals, but with a long-term growth element. Then there's your more classic cyclicals, which you were kind of touching on. These could be, commodity companies. There may be the cycle like an agricultural cycle, or it may be a GDP cycle. Some auto stocks, for example, those can go on sale. Indeed, auto stocks, a lot of the cyclicals got hit really hard in February and March this year and provided some opportunities. I've then got an idiosyncratic bucket, which is, I throw things in there, it doesn't fit in the other ones. And then there's another bucket, which is things that are in the hopper to be sold. So it's kind of, it's a bunch of stuff. And the cigar butts we mentioned, which is a very small sliver at the very end. But it's these categories. I'd love to have more in those first 3 categories, but sometimes opportunities present themselves in one of those less attractive categories because the valuation is so compelling.
Well, I mean, at the end of the day, you don't want to overpay for something and then only have it give you just a little bit of that extra, juice, where you can find something that's going to give you, more bang for your buck, if you will, over time.
Yeah, you're taking valuation risk,
Yeah, and they're not necessarily the sexiest names, but they're tried, tested, and true, and they're the ones that you go, oh, I didn't even think of that. And what I find is I think it's really easy when people look at it from this perspective. Again, you're not in the financial industry side. You have no idea what we're talking about in terms of price earnings and multiples and what does that even mean. Just think of it about how you would structure your own business. And I know there's a lot of business owners out there, just understanding the key components. So running a successful portfolio is no different than putting in the key components to how you would successfully run your business or grow your business. So your steady eddies are pretty much your legal team, your compliance team, your HR people. to keep everybody else in line. They're that foundation. Corporate governance, that's that piece. I want to say the growth, the secular growth is almost like having the key people in place from a leadership standpoint, and the ones that are, connecting with very important relationships to bring investments into the business to grow it. That's how I think of it. And then you've got these cyclical growth people, and those, I feel like that's your sales force, because sometimes your sales force can grow and shrink as time goes, but they're the ones that really are giving you those immediate wins, right, to add to that overall piece. And I feel like that's, if you apply it that way, you can kind of understand how the different aspects of a portfolio within those different buckets help long-term create a stable, sustainable, and strong portfolio that you want to keep. Yeah.
Nice analogy. I like it.
Yeah, thank you. So we kind of concluded on that piece, which I like. And we did touch on some of these headline news. So I feel like this is almost our little sub-segment of headline news and Total Wealth Views. Do people really need to be concerned every single day reading some of these headline news? I feel like the answer is no, and I know this, and I think you know this. But I think we really need to, and for everyone out there, it's really looking at the motivation behind how some of this headline news shows up. And I think it's more or less drawn toward the drama. People want dramatics, people want theatrics, and again, it's that buying into some level of narrative or that story. But it's really thinking about taking a step back and looking at it going, okay, but how is this relevant to me personally? And I think we're in this era of unrest, obviously, but it doesn't add to your peace of mind when you're always stuck on just the next piece of news that comes out. And so I think we need to really maybe share your insights in terms of the validity of some of this headline news, and really looking at, okay, so from trends, maybe if I keep seeing the same piece of headline news, or maybe written a different way over the next week, maybe I should pay attention to that, because it seems a little consistent. It seems like it's something is it going to affect me down the road? But what are your, what can you share with the viewers to tell them, how to better focus in on what really matters to them from a headline news perspective?
Yeah, how long have we got on a topic that's very, very dear to my heart. Yes, the long term is made up of lots of short terms put together, absolutely. Right. But we have just got into this crazy situation where you can get, minute by minute updates of the value of your portfolio. Imagine you were given that for your house. I would hate to have that information. My house is worth X, and tomorrow it's worth X plus 1%. What would you do with that information? Yeah. For some reason, we think that more information, more noise is better. And there's lots of studies that show that's actually nonsense. We need to be able to focus on what matters. One of the most influential books I read was by a chap called Guy Spears, The Education of a Value Investor. Guy Spears is one of the chaps who actually paid for a lunch with Warren Buffett many moons ago. And he wrote a book, and it's a really easy read, but he just talked about the need for him to switch off. He has two offices, one with all the information, the phone, the Bloomberg screen, etc. And then he has his office where he goes away to think and read. And I don't have two offices, sadly, but I pretty much try and create the same environment to get away from it, to be able to think about what matters. It's really hard to do when you're watching the news all the time. I stopped reading the daily newspapers. I still subscribe to the editorials. I read things like The Economist, right, a weekly, Barron's, a weekly. These guys are writing the news with like 2 hours. They've got to come up with some reason. And there's some hilarious examples of stories where the stock market's up today because the unemployment numbers were better than expected. And then at the end of the day, the stock market was down because the unemployment numbers were not as well as expected. It's the same information. We're trying to fit a narrative to it. And this whole thing about how we behave, your competitive advantage in investing could be threefold. It can be informational. You have better information or faster information than somebody else. Good luck with that. Analytical. You're brighter than the next person. Well, good luck with that one. But the third one is behavioral. You behave better. You choose to decide upon how you access information. You make a decision. We are what we read. We are what we expose ourselves to.
That's right.
What you will focus on, and more importantly, what you will avoid. And you then get aware of your biases. You know yourself and recognize them, prevent you acting emotionally. And I mean, you look what happened in February and March, the number of people who sold, the studies have shown, the number of people who sold their equities, all their equities, into that turmoil of the great, COVID-inspired downturn in the markets. And probably never got back invested again. It's, if you take away the 10 best days in the S&P 500 over the last 20 years, your return is dramatically reduced. Mm-hmm. So you've got to have a long-term perspective. You've got to recognize that the market, Mr. Market, that character is a manic depressive. He'll be excited and offering you high prices one day. You'll be depressed the next day. Look through that and have a long-term plan, invest and stick to it. Easier said than done.
Well, easier said than done, but that's the whole thing, right? Successful people that end up being very successful, it doesn't happen overnight, and it takes a lot of hard work. And I think too many people see the end result and go, well, they're doing it because they're just that way, or lucky them. They just got lucky. They don't take a step back and really appreciate all the failures, all the obstacles, all the blood, sweat, and tears, and the discipline that it's taken to grow over that time to get to where they are. I like to sharing this, and really, my focus, especially with the younger generations that are standing to inherit, funds either from their grandparents or their parents, is, I think we get too caught up and this is for a whole nother episode of really living with debt and having it be part of our lifestyle, which is an unfortunate thing. But it's really taking a step back and having them really think about how long did it take your parents or your grandparents to accumulate that level of money. And once it's in your hands, is it your first thought to go, well, I'm going to pay off my mortgage, I'm going to go on a trip, I'm going to buy that car that I've always wanted, I want that pool in my backyard. And I really asked them to think about, okay, so how long is it going to take you to save that same level of money you're just now receiving? And if they don't have a plan for it, if they don't have the capacity, given their lifestyle or their level of income, I think it's really worthwhile to take a step back and go, okay, I now have this opportunity with this money to just have it keep growing and actually add value to my life in stages versus taking it all, wiping myself clean, and then starting from scratch. So I think it's really, really important to appreciate the time and the blood, sweat, and tears that it's taken over decades for people to have accumulated the worth that they have. And, don't take it lightly when you are in that position where you're now receiving, this piece of wealth that's taken this long. It's almost like a legacy. It is a legacy. So you almost have to treat it as if, my God, like this is a gift that I want to keep growing versus, making myself net neutral. And now I have to rebuild myself over the next 30 years to get to where I have it in my palm of my hand right now. So I think that's important to really think about and focus on. That's definitely something I do, talk to my clients or their kids, right, when they're coming in, to just help them. Really, it's a level of appreciation, I think, because we take so much for granted at this point, and it's. I think COVID has helped. I think people realize and get back to certain basics of certain values and beliefs for them, and they've gotten rid of some of that noise of always being out and about or being busy doing other things versus just staying in one spot and appreciating people that are around them. So that's my rant for the day.
Nice rant.
So I think we talked about a lot today, Martin, and I think there's some great stuff here that I think the viewers will obviously appreciate, and I do thank you for your time. Like I said, I do miss you. I miss you, buddy.
It's been an absolute pleasure. I could have gone on for hours. I'm an opinionated Scotsman who's got a view on everything. But hopefully some of this, will strike a chord, and there'll be some value in it. But thanks for inviting me. And yes, I do miss you too, Penny. We'll get together soon.
We will. But again, we're always a text and call and Zoom away. So we'll continue with that. But for now, we'll leave our viewers at that. And if you like what you heard, and if you like this episode, be sure to subscribe, follow, and share to your family, friends, and followers. So thank you, guys, and we'll see you soon.